everybody, welcome back to my channel. In today's video, I'm going to answer the question, should you be buying real estate in 2023? You might be thinking, Nikki, real estate's the greatest asset class of all. Real estate's a no-brainer. Well, I'm going to cover the changing dynamics in our economy that could actually make you want to take a quick pause before you sign on the dotted line. To start, we're in an interest rate hangover. If this is interest rates, we are definitely not feeling too great after interest rates being held at zero, basically, for a very, very long time by the Federal Reserve. And if this is our interest rate hangover, this is our hangover from stimulus and the government spending that we've seen since the pandemic. What we've seen since the 2020 pandemic started is an absolute dash for people to go buy homes. Blame it on work from home, blame it on interest rates, blame it on whatever you want to blame it on. But the demand for housing actually skyrocketed. And with the demand for housing skyrocketing, we saw housing prices skyrocket. In fact, we saw some of the largest increases in home values ever. But now the fun is over and mortgage rates have shot up from around 2.7% at the lows all the way up to almost 7% today. This has massively affected affordability of housing in a time where we already had an affordability of housing crisis. You might be thinking, well, housing prices are starting to come down, and yes, they are. This is the US existing home median price, and we are starting to see it turn over and start to tick down, right? And people starting to decrease listing prices and people starting to not overpay or pay over asking for homes. Yes, we are, but it may not be enough. We still may not see demand slow enough to where we really see housing prices come in significantly. Unless, and here's the big kicker, the Federal Reserve continues to raise interest rates aggressively as they've been doing over the past few rate hikes, and they keep interest rates aggressively high for an aggressively long amount of time. That is what could change the entire dynamic of the housing market. So you may have thought to yourself, well, housing prices are starting to come down. This is good for me. Maybe I can, still swing buying a home even with mortgage rates up. And I actually saw this Instagram reel come across my feed. It was a realtor talking about how, a lot of people are maybe thinking about the housing market the wrong way because it's better to pay 7% interest on a home that you got under asking over paying over asking at 3% interest. And that's just simply not the case. Obviously, as most of you probably know, affordability is definitely an issue with interest rates increasing, assuming the same housing price, right? So if you assume a $400,000 home, a 20% down payment, and you assume an interest rate of 6.95%, we're looking at total interest paid of $442,000 over the life of the loan. I didn't include property tax or PMI or anything like that. This is simply, I just wanted to show you principal and interest. So this is a $400,000 home at 6.95%, and the interest is significant. And you can also see that reflected in the visual here, the light blue being the amount of interest paid. Versus looking at, don't forget, the monthly payment is $2,100 in this scenario. And then if you compare that, same price of the home, $400,000, 20% down, a 30-year fixed, the payment is significantly lower, and the interest paid over the life of the loan is absolutely significantly lower than at 6.95%. So a lot of people are arguing that it's not a big deal because you'll get the house under asking since people are starting to do that more and accept those offers. And so the 7% is not a big deal because you're getting the house for cheaper. You can even say, for example, you got the house for $50,000 cheaper. The $400,000 house became a $350,000 house with 20% down, still at the 6.95% interest rate, right? And if you calculate that, the interest over the life of the loan goes to $387. It's still a very, very hefty amount of interest that you're paying over the life of the loan. Now, the argument to this is that you can refinance the home, and that is true. You can refinance the home. But the point is, if housing prices stay persistently higher, Even if you're getting a deal on the home, the interest could be such a doozy. Even if you're getting the house for a little bit cheaper, it still could end up being less affordable than if you got the house and paid over asking at a much, much, much lower interest rate. So the real crux of all of this is, will housing prices stay elevated or will they come in significantly? If we see a deep recession, we could absolutely see housing prices come in more than expected. So what do you do? If you're interested in buying a home right now, you might be feeling very confused on what moves to make. Well, I've outlined 3 different scenarios and what you should do depending on the scenario that you're in. First of all, if you need a home and you want to buy a home, and buying a home makes more sense in your area than renting a home, meaning affordability between the two, then buy the home, but make sure you're making it affordable. Make sure you're not overstretching yourself with your mortgage payment with the expectation that you're going to be able to refinance. I would say take that in the back of your mind. Don't even think about it. Buy the home based on what interest rates are today, what the housing value is today, you know, the principal that you're going to be paying, and base it off of that. Don't base it off of what you hope will happen with interest rates in the future, hoping that you can refinance, because we don't know how long interest rates are going to be in this scenario. We are in a different economic paradigm. We are in a different monetary policy paradigm, right? Things used to be so simple. Interest rates were low. Assets increased in value over time. Buy the dip, buy the dip, buy the asset, buy the asset. But things have shifted, and we have to be mindful of that. So be sure to buy the home based on today's information, based on today's affordability, and don't count on something happening in the future that may or may not happen. If we go into a very deep recession, if the Federal Reserve pushes rates too high too far, we could very well see housing prices come in significantly in the future if a recession hits. So if that happens, you know, and your housing value declines a lot, we have to think about the loan to value in relation to when you go to refinance, right? You don't want to be in a situation where you're trying to refinance because you expected to be able to do that to get a lower payment, but housing values have come in so much that you're having a loan to value issue, and maybe the mortgage company won't want to give you that low of an interest rate. So that's something to just be mindful of. But if you need a home and you want a home and it makes sense in your area, buy the home and just make sure you're basing it off of today's information in terms of affordability, and don't assume XYZ is going to happen in the future. If you're a cash buyer, guess what? You are in the prime real estate environment. We are going into your time to shine. If you have cash, you don't have to worry about a mortgage. You don't have to worry about interest rates. And as interest rates rise, we are expecting housing prices to come in and kind of revert back to the mean because we saw such a huge spike. Hopefully, you'll be able to be in much better shape as a cash buyer now than you were just a year ago. So I would say that cash buyers are in a good position here and hunt down those deals. If you're an investor, okay, the third scenario, you may want to take caution in this environment right now. If you're taking on debt to try to yield a return in today's real estate environment, it's definitely a sketchy one to be doing it in, with the Federal Reserve potentially raising rates more and staying aggressive, and housing values may come in significantly in relation to that, because typically it's an inverse relation. As interest rates rise, housing prices typically go down because affordability becomes an issue. It's a supply-demand thing. However, we are still seeing a supply issue in the US with housing, so that could kind of help keep things afloat. That's the big question mark right now. So those are the 3 scenarios. If you are looking to buy a residential home for you and your family, and you really need a home and it makes financial sense and you can afford it at the current situation that we're in, then buy the home. Being able to refinance down the line is icing on the cake. Just be aware that a recession could lead to housing values giving you maybe some issues with refinancing due to loan to value, right? The second scenario is if you are a cash buyer, this is your time to shine. I think that you're going to be able to be in a good situation as housing prices continue to come back to reality. Third, if you're an investor and you're taking on leverage to be able to make returns in this market, make sure the numbers make sense, because as interest rates continue to rise, that could hit housing values, which could hit rents, and that could just completely affect your ability to make a return on your investment. So you have to make sure you're getting a good deal and you're structuring your deals well. So tomorrow, Thursday, November 10th, I'm hosting a special masterclass on how to invest during a recession. You're not going to want to miss it. Lots of knowledge nuggets will be in there, and you'll be able to ask me questions. Go to the link in the description to save your spot to that masterclass. If you found this video helpful, please like it and subscribe to my YouTube channel, please and thank you. And I will see you next time.